Good morning, everyone. This is Paul Duncan. It's early morning, Sunday, July 26, 2015. I want to give a quick rundown of what I'm seeing in the markets and how this is shaping my thoughts going into the new week here. What you're looking at here is my cumulative tick screen from TradeStation. And what's important to understand is that the red here means 52-week new lows. The green is 52-week new highs, and the difference between the two is represented in yellow. You can see if this is Friday, Thursday, Wednesday, Tuesday, Monday, you can see that red over green all week, and you can see that when we look at the cumulative tick, and this is the longest moving average that we have here, the instantaneous cumulative tick is well below the long-term average, or longer-term average is about a 10-day average, and as a result of that, it's pulling all of the moving averages down. Why that's significant is that the negative slopes on all of these indicate that on all measured time frames the markets are contracting. People are net sellers, independent of what you may see in the exchanges. And that's evidenced by the continual new lows that we're seeing on the New York Stock Exchange, 52-week new lows. This middle trace here is a filter. It's currently set to 500 stocks per minute. And what we're doing here is we're looking at the cumulative tick, and as long as I get over 500 stocks per minute ticking in one direction or another, I'll start getting a little notch down on a minute-over-minute basis. You can see that we were fairly benign starting off on Friday. There was a period there where we did sell off linear. It's almost boom, 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 minute over minute, just heading down. And then from about, 10:30 to approximately 12:46, more or less steady. I don't really put a lot of interpretation into this. But starting literally right around 12:45, 12:46, we just sold off for the remainder of the day, all the way up for about an hour. And it was almost exactly an hour where we just were heading down. And then a gradual sell-off as people lightened up going into the weekend. You can see the impact of that behavior is just on minute over minute. The cumulative tick was heading down, and that, of course, means that we're net sellers on the New York Stock Exchange. People were lightening up, and it just is not conducive to a rising market, even though we're into earnings season. So this tells me that we have to have a bearish stance on the short term, and that overall I'm not, until we start seeing some changes here and changes here, I'm not going to be a net buyer of the market. So what are we looking for? So if I go back in time, you can see that there's actually been some periods where good examples of what we're looking for. So we had a net negative here way back, and this was on, it looks like 7-9. And you can see 52-week new lows outpaced the new highs, but then the next day you can see the market started shifting, and now we get new 52-week new highs compared to the new lows, and you get net buying. And you can see how that is reflected in the cumulative tick. So the instantaneous white trace is starting to move up. And when these cross somewhere in this range, when all the slopes become positive, is really when I tend to really start buying in earnest, because I know we're into a 2 or 3 day buying spree, and people are going to start doing things. I don't try to time the bottom. It's these indicators aren't going to be good for that. But what this does do over the long term is tell me that we're okay to start moving into the markets. You can see though that only lasted up until, let's see, what's the date here, up until 7/17, and since 7/17 we've actually been dropping in terms of the overall markets. People started selling here, and it has just been accelerating to the downside. You can see that continually with the 500 per minute net decrease here. You can see that the new lows outpace new highs on a day-over-day basis. And of course you can start seeing the ribbon flip here, and as soon as the white passes below this bright red, everything starts being pulled down, and that's exactly the situation that we're in today. So going into early next week, until we start seeing some change in this behavior, the markets are contracting. Could be an opportunity for us, but Monday I do not see as being a buying opportunity for me. This behavior has had a overall change in status for us, and so with the close of markets on Friday, my short-term timer has moved back to cash. What that means effectively is that no new net buying, lock-in gains if we have them, raising equity or cash to 100%, equity exposure 0%. These are guidelines because I do keep my dividend portfolio fully invested. We do use this as guidance, but overall I'm not 100% in cash right now, although I will not be buying new positions in the bargains portfolio, the low beta portfolio, or the leaders portfolio. This is interesting to me in just the context of what we're seeing in terms of the long cash ratio. As many of you know, the long cash ratio is an indicator that I've developed that tells me relative to about 3,000 stocks in the database, half of them or some of them are rated on the long side, meaning they are historically outperforming over the past year the past behavior. And the ones that are in cash are underperforming their behavior over the past year. You can see we've been contracting on a day-over-day basis for the what I call the LCR. And you can see on Monday it was a 0% decrease from Friday. Tuesday was down 3%. Wednesday was only up 1%. Thursday and Friday were down pretty significantly. And we're at 0.473, which means that there are far more stocks in the database that are rated in some form of cash. For example, they are underperforming their historical averages compared to those that are outperforming, and that's fairly significant. We'll talk about those in a second. We had some, as many of you know, the slope concept here. I look at the slope of moving averages for the long cash ratio, and what we're seeing is that over the past 2 days, all the slopes have turned negative all the way out to the 143, which simply tells me that stocks are underperforming relative to their historical optimized values, and as a result, again, the database is contracting. It's evidenced by the cumulative tick that you just saw, and it's just not a good time to buy stocks on a short-term basis. We had some indications that this was going to happen. This is the slope of the slope. So think of this as the rate of change or the acceleration, either to the upside or downside. When it's red, it's to the downside. When it's green, it's to the upside. And this is the change in slope from this table. And so what this is basically telling me is that as far back as 717, we started getting some red across the table, which is a warning shot. And then, of course, it started across all measured time frames on Tuesday. And then by Thursday, pretty solid down numbers here. And what that effectively is telling me is that not to get too aggressive in buying at this period, because we are entering a market. Even though we had green over here, this is an early warning system that I've developed that tells me just to be cautious. So when we look at some of this, this is the 8-day EMA. I use that kind of as a canary in the coal mine, and what we're looking at here is we dropped very, very quickly. We came up for the few days, and I showed you that on the cumulative tick, and then boom, we're starting to reverse that path here. And why that's significant is that anytime we drop below zero on the 8-day, typically is a contraction period. It's really good to buy on the short-term basis when these things start reversing and going up, and it's not a good time to buy when these things are coming down, because you really don't know how far down they're going to go. That ribbon that you saw back on this chart here, you're basically looking at in graphical form right here, and what this is telling is that we're having a hard time making really strong highs. This is the index that I've created called the GGT index, and you can see we have lower highs, and we're having a hard time getting out of our way here and really getting into a robust market situation. because of a number of reasons. We can say perhaps we're looking at the left side here, the head here, and perhaps we're going to have a period here of decrease. Your crystal ball is good as mine, but I think what's significant is on the short-term basis, we know that all of the slopes are starting to point down here on a day-over-day basis, and until we start seeing some pretty aggressive movements up like this, it's just not a good time to get back in the market, full strength. I don't see it now, and in the upcoming week. One indicator that we have that we may be entering an oversold area, and it might not. This is one of the things that's driving me personally not to go to 100% cash. Is that historically when we get down into these levels, the indicator here isn't necessarily as important as just what the graphical representation is. You can see historically, looking back in time from, in this case 2013, anytime we entered these particular areas, we actually did start moving up in terms of the overall market. And so although we can certainly remain oversold for a while, don't fool yourself to think that just because we're entering this period it's going to turn on Monday. It's not. It does tell me that there could be some good buying opportunities down here, and really keep an eye on the market. Conversely, when you get up into these areas up in here, these are overbought areas, and as a result, the market is more prone to reduce itself down. What I'm seeing here right now is that we're entering a fairly strong indicator of oversold, and perhaps getting out of the market right now 100% is not a good idea. This is just looking at the price of the 65-day EMA, and all this is just basically telling me is the market in a long-term expansion or contraction phase. And what it's basically saying is that we're in a contraction phase. We're having a hard time making any progress here on the longer term. And if you've been index investing for 2015, you've probably seen this. You're not making any major headway. And sure enough, just taking a look here at where we were at the beginning of the year versus where we are right now, we haven't made hardly any progress whatsoever. The percent longs, as many of you know, I use this chart a lot. This chart tells us the number of stocks in the database out of about 3,000 that have a long rated recommendation, meaning they are historically outperforming their optimized values. We're in the green area, and what that basically says is that on a long-term basis, buying in these areas has typically been rewarded. Again, you have to take it in context. Are we falling, or are we going to hit a short-term local minima and start heading up? Right now we're falling, and as a result of that, I don't recommend doing anything early in the week. But what's important here for me is that we're in the green. This is a buying zone, and so when we do get the appropriate signals, I will be fairly aggressive in my buying. We'll just have to wait and see. This last one is just taking a look at what does the long-term market indicate for us, and it's on a negative, basically do not fully commit recommendation right now. And it's basically it failed. If this is the zero line, we're having a hard time getting out of our way. Again, the markets are not in an expansion phase. They're in a contraction phase, and that's evidenced by this. So basically telling me be very, very careful here. As far as overall stocks, I've updated the GGT Dropbox folder, and if you go down, you should see these appearing in your Dropbox. The dashboard has been updated, and basically what this is telling us, I've got the updated values for the dividend portfolio, the bargains portfolio, the leaders portfolio, and then the dividend champions for portfolio. And low beta here at the bottom. Had a major update of the database this week. I had some complaints come in that the description and industries weren't correct for a few stocks, so I went through a major update of this. I use a service for this. It costs money, but hopefully for those of you who are noticing that the industry was out of sync with what the actual stock is, you'll be pleased with what you see. Everything should be aligned, and you can go into industry, the industry tab, and you should be able to see what you want to see here. Um, what this is telling us is basically we do have a number of stocks that are flipping over to new cash. In fact, if I go over by recommendation and we go to the bottom here, you can see we have a lot of stocks that have flipped over, telling us that if you're holding any of these positions, you should be thinking about getting out of them. They're underperforming their historical levels. I personally filtered a little bit more than that, so I typically only use the stocks on this screen. These are part of what I call my greenfield screen, and I'll show you that here in a second. What's key here is that in terms of the amount of green versus red, you can see we have still have quite some opportunities here to get in to stocks when the signal comes. So why that's significant to you, let me put a filter on here. Data filter, and then just pick just the long rated stocks. What you're looking at here effectively these are candidate stocks that when a market does turn that I would be looking into. So I concentrate on the long rated stocks as well as stocks that have a value that is greater than about 3. This is a Calmar. Calmar is a risk to reward historically. Compares the gains over the drawdowns over the last, I use a 1-year period, and you can see that benefit here, peak GGT drawdown compared to just to a buy and hold, and you can see that GGT keeps you out of trouble more often than not. Here, buy and hold would have been a 20% drawdown. With the GGT methods, you're only looking at a 7.5. And so when you look at the gains versus the drawdowns, you're looking at a Calmar of about 5.2, and so that's basically how I look at that. So I'm looking for values greater than 3, and you can see for the most part we have for the greenfield leader bargains and low beta stocks. You typically have got some pretty solid stocks in here. I buy alpha with the greenfield strategy, and so hence you're going to see some pretty good numbers here. So what does greenfield mean? A lot of you have asked that. As many of you know, I have a screen here in TradeStation, and basically I'm looking at pricing performance over here on the left hand side. I'm looking at revenue performance here in the middle, and then I'm looking at EPS performance here on the right hand side. And effectively what I want to see is I want to see green. I've got threshold values set in here, and as long as these are green, then it becomes part of the leaders or it becomes part of the bargains. And bargains here, still note revenues and EPS are intact for these stocks, but I will allow some semblance of decrease in price because they're bargains, right? We have good fundamentals, but we have an area here where the price has been beaten down. This is the closed minus below the 50, so you can see a lot of these stocks are below their 50-day moving average. In this particular case, these 3 stocks, IDRA, BJRI, and LABL, are all sitting very, very close or just above their 50-day moving averages. Again, I look at all of these and make some determinations. You can see more red over here. Again, this is on the low beta. The low beta portfolio literally looks relative to the S&P 500, and I pick out betas that are below 1, which indicates that they are not as volatile as the S&P 500. The dividend stocks, fairly light list right now. This list has been lightening up for a number of days. If not weeks, but these are stocks that have accelerating dividends on a quarterly over quarterly and year over year basis. I think what's significant here is that since this is lightening up, we're starting to see some failures in the revenue and the EPS values for this, but nevertheless the list is there and it's in that stock file. Dividend champions, again, you're going to see a lot of green here. The yellow, by the way, in all of this is just that TradeStation over the weekend is going to be posting some updates. So the list may be further refined on Monday at the open when they do populate or make these new values available. But going into Friday and yesterday, I had green on all of this. And so the dividend champions is a product of David Fish's work, and basically, again, solid revenues, solid EPS, but beaten down in terms of price, performance, and things related to that. You can see the best dividend champions. These have, by the way, dividend champions, according to his definition, have year over year and quarterly over quarterly stay the same or increasing dividend payouts for, I think the average right now is beyond 11 years. So these are very, very safe dividend paying stocks, the best of the best. You can sort by this column over here called score, and you can see that in this particular case I'm looking at AFSI, CMN, HCC, AET, Ozark, and MKTX as being some of the best stocks. And I do this for you automatically in this chart because those, by the way, are the same qualities of stocks that I use here. So this really represents the best of the best in terms of dividend safety and dividend payers. The stocks that you see down here, the greenfield dividends, the best of the best is going to be reflected in the higher CalMAR numbers that you see over here, and they would be buying opportunities as long as that they are green here. Let's see, back to TradeStation here. Oops. The breakouts are literally, for those of you who are on the alert service, this is the alert page. I have a service set up under this indicator where I notify a number of folks whenever we get breakouts on given stocks, and so this is already primed for Monday. You can also see that we have earnings coming out, and the things that are green show us that we have a lot of earning payouts coming next week. It's going to be fairly significant to watch and see what happens. You may get breakouts. I only send the emails and the text messages out for the positive side. I do not send them out for the negative side. But basically, the criteria for them is for this is that we're going to take out the high as well as volume, the highest volume over the previous 10 days, and that, as many of you know, is called a pocket pivot. The rest of this is irrelevant. Basically, I'm watching a whole bunch of stocks here to pop up. You can see that TradeStation has not populated the data, so I'm looking to see how we perform. These would all be candidates that would fall under what we see over here. So the takeaway from all of this is simply this. We've got decreasing market buying action combined with the dashboard performance here, as we're seeing the LCR is contracting. On a short-term basis, I'm actually seeing, the SPY, a recommendation to short the SPY, a recommendation to short the Qs, IWM. So across the board here, in terms of the indices, we've got to be fairly careful in terms of getting into the market on the long side. The timer did flip over to the negative side. It's basically telling me to exit everything. And historically, this has been a very good timing system. It's provided really, really good returns on the overall system, averaging 12% with very, very good efficiency with less than 50% market exposure. We've actually been out of the market for some time. You can see that the re-entry did try to get us back in here earlier this week, but it ended up being a losing candidate. Always use money management anytime that you're going to get back into the market, because you don't know if things are going to fail. So bottom line, I am not getting too aggressive this week. I am going to, in terms of the overall portfolios, which I'm managing here at Collective 2, the dividend portfolio, as many of you know, has been doing pretty well. Let me flop over here and show you. It's held up fairly well consistently for the time frame that it's been in the market. I started it on June 3rd. We're outperforming the S&P 500, but we did fall this week as expected. It's 100% invested, and this is not unexpected behavior. The other portfolios have limited exposure right now. You can see the bargains portfolio is under underperforming the S&P by a very, very small amount. But it started with a $30,000 portfolio size, and I've got 22,000 of cash available, or 21,000 of cash. And so what this is basically telling me is that I've got a very, very high cash level, and this is the money management that I employ. In terms of the stocks that we're holding right now, I am unloading some of those, and again, you can see I wouldn't use it as a tracker because I update it after I've done the trades, but you can see on the portfolio tab basically what I'm holding and what I'm going to be doing. I typically don't post the buys here until after they post over into Collective 2. I've got very good confidence that over time these are going to do pretty well, and if you are interested, you can always go down into the statistics of the tabs and learn a little bit more about what the expected behaviors or what the historical behaviors are going to be. So bargains, dividends, leaders. We're outperforming the S&P. Again, started that around June 10th. Cash value within this account is pretty high. Started it with 25,000. So we've got a fairly high cash level here in this account. So just slightly outperforming on the leaders portfolio. Again, I'm just waiting to get in to the market and fully commit. And on the beta portfolio, although we did come down for the week, still outperforming the S&P 500. And again, should be able to indicate a fairly high level of cash here. Again, started with 30,018, so I only got 12,000 committed to the system right now. So my intention is to unload a few positions here. You can see that again from the GGT stock folder, and when I've got some positions that I'm unloading here for the week. For Monday, going into Monday, and the idea behind this is I will also be buying some stocks. I won't get to that until later today due to family obligations, so I'll post those probably tomorrow or Tuesday if they load. If you are a subscriber, you obviously will get immediate notification of pending orders, and you can kick the tires here, by the way, for free for a period of time if you're so inclined. So that's all I've got. I do advise caution for the week. I wish everyone good luck, and if you got any questions, feel free to post them in the Yahoo group, or send me a tweet, or send me an email. Thank you very much, and have a great rest of the weekend. Bye.